Uranium prices are surging, and nuclear energy is back in the spotlight as governments worldwide turn to atomic power for energy security and carbon neutrality. While big names like Cameco and NextGen dominate headlines, one US-based company might be the most underappreciated opportunity in the sector: Uranium Energy Corp. UEC owns one of the largest fully permitted ISR project pipelines in the United States and is strategically positioned to benefit from America's growing focus on reshoring uranium production. With advanced infrastructure, strong financials, and exposure to rising spot prices, UEC appears increasingly mispriced relative to peers. So, is this the best-kept secret in uranium investing, or just a story stock that hasn't materialized? Before we dive in, be sure to subscribe to Stocks Telegraph for more deep-dive investing insights. And let us know in the comments, are you buying UEC or keeping it on your watch list? Nuclear energy is undergoing a global renaissance. As countries seek energy independence and reduced emissions, atomic power is gaining renewed support. Nations like the US, Japan, India, and China are investing heavily in nuclear infrastructure, with 6 more countries recently pledging to triple nuclear capacity by 2050. Small modular reactors are also gaining momentum as flexible, modern alternatives. Meanwhile, uranium supply is constrained. Major producers like Kazatomprom have slashed output forecasts due to operational issues, while Cameco's Inkai JV in Kazakhstan has also paused production. These disruptions have pushed uranium spot prices up over 50% year-to-date. TradeTech reports nearly $20 per pound gains over the last 6 months alone. His supply-demand imbalance creates an ideal backdrop for well-positioned producers like UEC to thrive. With nuclear power gaining policy and investor momentum, uranium stocks could be in for a multi-year uptrend, and UEC may be at the center of that move. UEC is a uniquely leveraged, US-based uranium company with a fully unhedged production model. That means its revenue potential scales directly with spot uranium prices, an attractive setup in today's rising market. Its operations span 2 ISR hubs, the South Texas platform, anchored by the Hobson processing plant, and the Wyoming hub, centered on the Irigaray facility. These serve multiple satellite projects including Palangana, Burke Hollow, and Reno Creek, making UEC one of the most scalable ISR operators in North America. The acquisition of Uranium One's U.S. assets added significant resources, while physical uranium holdings and a debt-free balance sheet give UEC strategic and financial flexibility. Its inventory of over 1.3 million pounds of U3O8 also provides a hedge against price volatility and could be monetized when market conditions are optimal. UEC's valuation highlights the disconnect between market cap and underlying assets. Its current market cap hovers around $1.14 billion, well below peers like NextGen, despite comparable resource size and potential output. Financially, UEC stands out with over $214 million in cash and no debt, enabling project development without shareholder dilution. Its uranium inventory, valued near $97 million, further strengthens the balance sheet. The company's acquisition of the Roughrider project from Rio Tinto at $2.59 pound, when the market valued pounds in the ground at over $4, shows savvy capital allocation by many metrics: EV pound in the ground, cash position, infrastructure readiness. UEC trades at a noticeable discount to its peer group. UEC is on the verge of transitioning from a developer to a producer. It resumed production at the Christensen Ranch ISR facility in 2024 and is pursuing a capacity expansion at its Irigaray plant. These milestones signal real operational momentum. With no fixed-price contracts, UEC remains fully exposed to rising uranium prices, a rare feature that appeals to investors seeking torque on the spot market. The U.S. government is also backing domestic uranium. Initiatives under the Inflation Reduction Act and Advance Act, plus DOE reserve purchases, have created an ideal policy environment for U.S.-based producers. Institutional investors like BlackRock and Vanguard are taking notice, and UEC's inclusion in uranium ETFs is boosting visibility. Its relatively low float and high beta mean it could outperform dramatically in a uranium bull run. The company's strategic assets and U.S.-based production make it a likely beneficiary of future DOE contracts and nuclear supply chain initiatives. Despite its potential, UEC is still early in its production ramp. Without consistent cash flow, it remains somewhat speculative compared to peers with ongoing sales. Volatility in uranium prices could impact performance given its unhedged model. Operational delays or permitting setbacks, especially in ISR processes, are risks as well. Even minor production hiccups can affect revenue timing and investor sentiment. UEC also competes with larger producers like Cameco and low-cost international players like Kazatomprom, which have broader customer bases and more established supply chains. Execution risks and geopolitical noise could weigh on near-term sentiment. Technically, UEC appears oversold. Its RSI hovers near 30, indicating potential for a bounce. The stock is trading below its 20, 50, and 100-day EMAs, suggesting bearish momentum, but also opportunity if sentiment shifts. Support lies between $4.55 and $4.71, with resistance at $4.76 and $7.19. MACD is negative, but a crossover could spark renewed buying. Recent price action may be signaling base building ahead of a potential breakout. Retail sentiment remains strong on forums like Reddit and StockTwits, where many view the dip as a buying opportunity. However, insider activity shows more selling than buying over the past year, something investors may want to monitor. Institutional flows into uranium ETFs that hold UEC are worth tracking for signs of accumulation. UEC offers one of the most compelling setups in the uranium space: a large resource base, fully permitted ISR assets, a debt-free balance sheet, physical uranium inventory, and full leverage to spot prices. It's already resumed production in Wyoming and is expanding capacity across multiple projects. Analysts see significant upside, with price targets ranging from $9 to $12.25, more than double current levels. The Rough Rider acquisition alone brings nearly $1 billion in post-tax NPV and a 40% IRR. UEC's combination of scale, financial strength, policy alignment, and growth potential makes it a standout in a sector that's just heating up. That said, investors should stay mindful of its early-stage production, macro uranium risks, and competition. For those bullish on nuclear energy and uranium's long-term demand, UEC may offer one of the best asymmetric bets in the market today. As global uranium demand accelerates and the U.S. rethinks its supply chain, UEC could emerge as a core holding in next-generation energy portfolios. So what's your move? Is UEC a hidden gem ready to roar, or a stock that still needs to prove itself in the production game? Drop your thoughts in the comments. We read every one. And if you're into spotting energy sector opportunities before they go mainstream, smash that like button, subscribe to Stocks Telegraph, and ring the bell so you never miss a beat. Thanks for watching, and we'll catch you in the next one.